Hello, and welcome to Portfolio Matters Weekly Markets Checklist, week 195. Before I get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we'll be discussing securities that we own or have financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Now, before I get going, some housekeeping news. I'm afraid Richard's back has gone, and he's currently lying on the sofa in pain and unable to record PM with me. So this week, I'm afraid you just have me. Um, and the next podcast will be in 3 weeks' time, as I have a couple of trips over the next couple of weeks. But first of all, the news. Political turmoil in France continues. Prime Minister Francois Bayrou had to resign after calling and losing a no-confidence vote on the 8th of September, and President Macron has since replaced him with Ali Le Cornu. So the fundamental problem for President Macron is he is trying to cut the budget deficit. Bayrou had attempted to cut the fiscal deficit from 5.4% to 4.6%, but had not got any support in doing that from the opposition parties, which have a majority in parliament. After calling elections last year, Macron is a minority government. Hence, he can't force this through parliament. We have a special section on France coming up. Fitch separately has downgraded France's credit rating. In the UK budget will now be in late November, so the uncertainty surrounding tax rises will continue for longer than usual, as the budget is normally in October. And separately, Sir Keir Starmer has set up a budget board linking top ministers and officials from number 10 in the Treasury, bypassing number 11, which rather undermines the Chancellor, Rachel Reeves. But the aim is to avoid another bust up with business or sell off in gilt when the budget is announced. OPEC Plus met and agreed to boost production by a further 137,000 barrels a day in October. So far this year, they've raised their production target by 2.5 million barrels a day. And turning to equities, Oracle shares rose an astonishing 40% in a day on booming cloud computing revenue. Have a section on that coming up. Economic news, well, the big news was US non-farm payrolls came in soft at only plus 22,000 in August versus 75,000 expected. And separately, the annual benchmarking of non-farm payrolls to the census resulted in it being downgraded by 911,000 over the past year, i.e., non-farm payrolls had overestimated jobs growth by 911,000. US inflation ticked up in August to 2.9%, core was at 3.1%. EU inflation ticked up to 2.1%, core was at 2.5%. Markets news, well, equities continue to rise. Precious metals have had an astonishing couple of weeks, very strong. Bond yields are down slightly after the non-farm payrolls data, which confirmed that the US labor market was weakening, and the Fed is expected to resume its rate cuts this week. The ECB met and held rates at 2.15%. Christine Lagarde is saying the disinflationary process is now over for the euro area, and that the monetary policy is well balanced and could go in either direction from here. But separately, she said that core inflation is likely to keep on falling due to lower labor wage pressure, and also due to the strengthening euro. So it would seem that the risks to inflation are to the downside, and we expect the ECB to keep cutting rates, although at a slower pace. Fitch has downgraded France's credit rating. We have a section on France coming up. Now, the Fed meets later this week, and the markets are pricing in a near 100% probability that they will resume rate cuts. The Fed has a problem. So inflation has picked up quite sharply over the last 3 months, but the labor market is slowing. So there's a contradiction between its two mandates. It's expecting that surge inflation to be transitory. We've heard those words before. And so we'll resume cutting rates. Markets are pricing in an astonishing 160 basis points of Fed rate cuts by January 2027. So over the next 15 or 16 months. That seems a lot. And on to equities. Well, it's been a very strong couple of weeks for equities. The all world is now up 16.5% for the year. The all share up 12.5%. Stocks are 600 up 10.3%. S&P 500 up 12.5%. Even the Russell 2000 is now up 8%. NASDAQ, very strong couple of weeks, up 15.7% for the year. Hang Seng up 32%. Topics up 14%. Bitcoin up 25%. Sterling up almost 9% versus the dollar. Euro up 14% for the dollar. Dollar index down 10% as Donald Trump undermines Fed independence and weakens global confidence in the US as a trading partner. So this is the all world. That's just trending steadily upwards. No sign of the usual autumn squalls in the equity markets. The all share, Europe, stock 600, S&P 500 just trending steadily higher, now up 12.5% for the year. NASDAQ Composite, very good couple of weeks, up 4.2%, up 16% for the year. Russell 2000 up 8% for the year. Hang Seng up an amazing 32% for the year. Topics 14%. Bitcoin up 25%. Sterling up 9% versus the dollar. Euro also doing well. Dollar index declining. That is bad for US inflation. VIX nowhere. Markets complacent about equity risk. So we're now halfway through September, and stocks normally fall in September. September and October are the traditional periods for market retrenchment and crashes, and there's no sign of that this year. And if we look at sales growth for the S&P 500, well, it has been broadly strong. The only sector with negative revenue growth in 2025, the year to June, is the energy sector. Information technology has done astonishingly well, up 14%. But broad sales growth, even real estate, up 9.2%. However, if you look at the S&P mid-cap and small-cap indices, sales growth for the mid-cap was only 2.1%, and for the small-cap, only 3.2%. So, which means that their sales are growing essentially in line with inflation. So when we see the Russell 2000 doing so well, that is all due to margin expansion. Their profits are not growing in real terms. The rebound from the April sell-off, Liberation Day sell-off, has been of historic magnitude. Really astonishing. The NASDAQ has had a good couple of weeks, and the IT sector continues to drive this market. Valuations are getting more and more stretched, but that does not seem to be deterring the market from continuing to rise. If you've been in the market so far, very well done. And everyone is still long tech. Now, I thought this was surprising. So when you look at sources of total returns over the last 12 months, in the US, actually, the main source of returns has been earnings and dividends. Elsewhere, it's been expansion of valuations, PE multiples. So particularly the Euro area and the UK. The UK and European economies are not doing very well, but markets are willing to pay a larger premium for buying equities. And I thought this was very interesting. Thank you to Jaded Persimmon for sending this through. This is the returns of 245 IPOs on the NASDAQ between 2018 and 2023. And you'll see 90% of them plus actually lost money. Only a few of them did well, and those did very well. So when playing the equity market, it's really important to bail out of losing companies and buy the winners. Okay, and on to commodities. Energy markets were weak. Industrial metals were mixed. Precious metals were very strong. So turning first to commodities. So Brent down 0.9%, down 9.5% for the year. WTI down 1.7%, down 11.4% for the year. Natural gas futures in Europe down a bit, down 0.6% over the last couple of weeks, down 36% for the year. UK natural gas futures down 1.1%, down 37% for the year. US natural gas up 2.7%, but still down 17% for the year. UK, it's starting to get cold. We have turned our central heating on. So you might have expected that natural gas futures would have risen over the past couple of weeks, but not the case. And that is good news for inflation. Coal has resumed its slide, down 7.4% over the last couple of weeks, down 20% for the year. Uranium down 2% over the past couple of weeks, but up 3% year to date. So this is Brent. So OPEC Plus threatening to increase production by 137,000 barrels in October. Now, the reality is that only Saudi and the UAE probably have spare capacity. So you won't get a full 137,000 barrels extra in October, but OPEC Plus continuing to increase production, and that is bad for the oil market. WTI going nowhere, towards its lows. So numbers specific to the oil market, well, in the US over the past couple of weeks, we've had a big build, around 23 million barrels. So the US market has been oversupplied. US crude production ticked up by 56,000 barrels a day and is now down only 80,000 barrels a day year to date. And that comes despite a big drop in the rig count. Now, it takes a year for a shale oil well to come online after drilling has started. So that drop in the rig count should start to feed through to lower oil production probably next year. But so far, the US oil industry has coped very well with falling rig counts. And reminder, the shale revolution is a technology revolution. They're continually increasing productivity. Has increased productivity once again compensated for falling rig counts? According to HFI research, US oil production is back to its all-time highs despite the falling rig count. There's an EU natural gas futures, no sign of a pickup. That's great news for inflation. Same in the UK. US natural gas futures subsiding again. Coal, that rally between May and August has proved to be temporary. It's now subsiding again. Uranium, is that the bull market back on? Onto industrial metals. Well, rather a mixed picture. Aluminium, copper, and iron all doing well. Lithium has had a great run up from its recent lows, but subsided again. Neodymium, stable at its peak, having risen almost 60% year to date. Zinc and nickel weak. So this is aluminium, good couple of weeks, now up 6% on the year. Cobalt, up 37% on the year, but that is an artificial market. DRC has stopped exports. Copper, recovering from recent lows. Iron ore, is that a sign that the Chinese construction industry is doing a bit better? Lithium, down from recent peak, but now flattish on the year. Neodymium, again, you think this is an artificial market caused by Chinese restrictions on rare earth metal exports. Nickel, going nowhere. Tin, steadily rising. Zinc, again, steadily rising. All of them recovering from the worries over global trade and tariffs in April. Onto precious metals. Richard, such a pity Richard is ill because he's been dead right. The bull market in gold continues, up an astonishing 6% over the past couple of weeks, 40% year to date. Silver joining in, up almost 50% year to date. All the precious metals doing incredibly well. There's gold, just relentless rises. Real gold prices are almost back to their all-time highs in the early 1980s. Silver doing incredibly well, following gold. Platinum also doing very well. All the precious metals, hard monetary assets are doing very well this year. Congratulations to Richard and everyone who holds them. And moving to rates. Well, the good news is that the UK yield curve has shifted down a bit over the last couple of weeks, helped by the weakening US labour market, which has brought US rates down at the short end, but has led to a shift down in the whole yield curve. You'll notice that the UK 2-year is not really much below 4%. So the market is not pricing in the Bank of England cutting rates much below 4% this cycle. Now, I think that is wrong. I persist in my so far delusional belief that weakening UK labour market will lead to falling UK inflation, which will lead to lower UK yields across the curve. Now, we know that in November, Rachel Reeves will have to raise taxes, which will tend to slow the economy further. And as we have discussed previously, the UK economy is barely growing at the moment, and that will tend to slow the economy further. In order to stimulate the economy, the UK then has two choices, given that it will be tightening fiscal. It can't do fiscal. It will either have to ease monetary policy or lower the exchange rate. I suspect both will happen. In the US, the yield curve has shifted down decisively over the past couple of weeks due to the weakening labour market, particularly at the short end. As we discussed earlier, the market is now pricing in 160 basis points of further rate cuts in the US by January 2027. Now, long yields remain very elevated, and that is despite the market expecting 160 basis points of rate cuts in the US over the next 16 months. Are we now in an era where long bond yields will be permanently higher, will have a much steeper yield curve? In order for long bond yields to come under control, then governments need to get their finances under control and inflation needs to come back towards the 2% target. Turning to Japan, there's been a big rise in long bond yields. The red line is the 10-year, 20-year forward. So it's what the market is expecting 20-year forward bond yields to be starting from 10 years' time. And the big sell-off since 2024 has coincided with really a minuscule reduction in the Bank of Japan's bond holding. You'll see that the Bank of Japan's bond holdings as a percentage of GDP are double that of the next highest central bank, which is Italy. If the relatively small amount of QT that Japan has done has caused this huge spike in Japanese bond yields, then there's a long way to go, and Japanese bond yields could head a lot higher. Japan faces an unenviable dilemma. It either continues to run low interest rates, in which point the currency will take the strain and there'll be further yen depreciation, which will cause rising inflation. If, however, it raises interest rates, then because it's got debt to GDP of 260%, it risks a debt sustainability crisis. Which one will it choose? I strongly suspect it will keep interest rates low and risk further yen depreciation. Turning to the UK, this is the Bloomberg Index for bond market liquidity. And see, liquidity in the UK is terrible. QT appears to be overwhelming demand for UK government bonds. So the UK 10-year currently trades at a 1% premium to French 10-year, despite the fact that the UK has a lower fiscal deficit and a plan to get its fiscal deficit under control, unlike France. So is the risk premium that the market is demanding to hold UK gilts really a liquidity premium? And will that come down when the UK ends QT? Reminder, the Bank of England meets this week and is expected to hold interest rates unchanged, but the market is speculating, anticipating that the Bank of England will slow the pace of QT from 100 billion a year to 75 billion next year. The market no longer appears to be worried about a US default, though I do wonder how this chart is measured. Is it from a CDS, credit default swap? Not sure. But anyway, ostensibly, it would appear to show that following the early months of Trump's presidency, when there was a spike in concerns about US sovereign risk, those risks have now disappeared. Okay, this is the UK 2-year, really not going anywhere. The market does not yet believe that UK inflation is under control and that the Bank of England will be able to cut interest rates much further. This is the 10-year. I think you can say that is stable, but not coming down. The 30-year, too early to say whether that is a peak, although down from its recent highs. US 10-year, that appears to be coming down. German 10-year still appears to be on a rising trend. France, not good. I have a section on France coming up. Italy, stable. Greece, stable. Japan, rising relentlessly. Now, that needn't cause Japan any short-term problems because it can fund itself by issuing short-term bonds at an interest rate of 0.5%. Japanese inflation was 3.1% in July, so interest rates of 0.5% are strongly negative in real terms, and that will tend to cause further yen weakness and persistent inflation. Okay, on to this week's economic data. And a quick summary. UK stagflation. Inflation continues to rise. It's expected to peak in September, i.e. this month. So we won't get those numbers until October. The economy is stable, not really growing very much. EU stagnation. Inflation is around target at 2.1%. Growth is highly indifferent. The US labour market is slowing, but it's still growing at around 2%. Numbers that the UK would kill for. China, stagnation. Inflation is about zero, and the economy, according to the official statistics, is growing at trend, but all the data we've seen recently has been weak. Okay, moving on to the UK. So This is UK GDP for July, which was 0, in line with expectations, down on June, 1.4% year on year. Not great. Data out this morning, average weekly earnings were in line with expectations at 4.7%, up on June, not great. The good news is that in July, wage growth, excluding bonuses, did come down to 4.8%, in line with expectations. And when you look at that chart, it is encouraging. The ONS provide more granular data, and they show that private sector wage growth is now 4.7%, which is below public sector wage growth. And construction industry is at 3.9%. The problem is in the services sector, which is 6.4%, but is coming down. The problem in the UK is that persistent inflation leads to persistent wage demands. So if inflation's at 4%, people are going to be demanding 4 or 5% wage growth. We are in an inflationary spiral. So the Bank of England needs to keep interest rates high to squeeze the economy, to squeeze the labour market, to get inflation down. And the longer this persists, the longer interest rates need to stay high and in positive territory in real terms. 3-month employment change remains mystifying. So in the 3 months to July, the labour force survey is saying that the UK created 232,000 jobs, which was above expectations but below the June number. And that the unemployment rate was flat at 4.7%. But then when we look at the HMRC payrolls data, and you look at the 3 months to July, according to HMRC, the number of people on payroll fell by 50,000, whereas the labour force survey is reporting plus 232,000 people in employment. No idea. You would expect that the HMRC payrolls data is more accurate because it's hard numbers. The claimant count in August rose by 17,000, which was below expectations. The July number was revised heavily downwards, so 33,000 people came off unemployment benefit in July, and that compares to a previous number of 6,000. Retail sales in July were much stronger than expected, but the June number was revised down heavily. So as a result, July year-on-year retail sales were weaker than expected at 1.1%. Bank of England consumers' credit is absolutely fine. Net mortgage lending is fine. And hence, total net lending to individuals is also fine. Money supply grew 0.1% in July. Construction output actually surprisingly strong, 2.4% in July year-on-year, better than expected, and up on June. Construction PMI, though, remains firmly in negative territory, though up on July. Industrial production in August was minus 0.9%, not great, well below expectations, and year-on-year 0.1%, i.e. not growing at all. Halifax house prices, 2.2% year-on-year, fading, but still positive. Balance of trade, this is a depressing chart, was minus 5.3 billion in July, pretty stable since June. Citigroup Surprise Index, positive. The UK economy, better than very weak expectations. Job postings index, the decline has slowed, I think you'd say. The good news is that after the very depressing bounce in July, UK wage growth for advertised wages fell to 5.6%, still way too high. However, this is a new chart from Indeed, and what it shows is an increasing number of UK job postings don't explicitly state a salary. Hence, this chart only presumably uses around 56% of the data, because 44% of UK job postings don't have an explicit salary attached to them. Now, is that a sign of a weakening jobs market? You would expect so. And finally, we've talked about this many times, but this is UK electricity prices. And you'll see that over the past 25 years, they have trebled, whereas US electricity prices have barely moved. And that is all because of the shift to renewables. And you'll note that earlier we showed that UK industrial production is unchanged year on year. Well, the two are connected. Can't have energy intensive industries in the UK when our electricity and energy costs are treble that of other countries, the US in particular. So in summary, UK earnings growth remains far too high, but does appear to finally be coming under control. UK GDP growth remains indifferent at 1.4%. Stagflation. And onto the EU. So the ECB met and kept interest rates unchanged. GDP growth in Q2 was 0.1%, and presumably that includes a little bit of additional exports pre-tariff to the US. So 1.5% year on year, not great. Inflation ticked up in August to 2.1%. But pretty much in line with target and stable. Core 2.3%. Producer price inflation going nowhere, 0.2% year on year. That's great news. Retail sales were down 0.5% in July, 2.2% year on year. Not great. Construction PMI ticked up to 46.7. Good news, but still in contraction territory. Like the UK, the EU economy is beating very poor expectations. Surprise index at 19.1. The job postings seems to have stabilized in Germany. Wage growth 3.3%, but only 13% of indeed job postings in Germany have a wage, have an explicit wage attached to them. So are they only using 13% of the adverts to calculate this number? In which case it's unlikely to be reflective. We turn to France. Well, for that trend seems to be intact, frankly, a little bounce over the last couple of weeks, but job postings continue to fall, wage growth stable at 1.9%. EU summary GDP growth was an anemic 0.1% in Q2, year on year 1.5%, marginally better than the UK. Inflation ticked up to 2.1%, but broadly in line with the ECB's 2% target. Stagnation. Expect the ECB to continue cutting rates, frankly. And onto the US. So the big news was non-farm payrolls for August came in at a very disappointing 22,000, well down in July and well below forecasts. And revisions to the June and July numbers shaved a further 21,000 off historic job numbers. And the June number, after those revisions, is now negative. That's the first negative print of this cycle. Turning to individual sectors, well, the main drivers of jobs growth in the US continue to be education and health services. Construction finally has started to shed jobs. Now, reminder, the way a recession normally starts is the construction sector and manufacturing sectors, they're both highly cyclical. They shed jobs, and that reduces demand in the rest of the economy, resulting in a negative spiral. So is that starting to happen? Question mark. The equity market remains totally unconcerned. So excluding healthcare, the US economy has lost 142,000 jobs in the last 4 months, the most since 2020. The household survey, however, reported jobs growth of 288,000 in August, following a fall of 260,000 in July. So choose your poison. Is it the establishment survey or the household survey? Establishment survey, non-farm payrolls, very weak. Household survey, much stronger in August. And every year, the non-farm payrolls report, which, reminder, is mainly a model, is benchmarked to the census, and the latest benchmarking exercise will result in non-farm payrolls being revised down by 911,000 over the past year. So non-farm payrolls has been too optimistic about US jobs growth to the tune of 911,000 jobs over the past year. Turning to earnings, decent enough earnings growth in the US, 3.7% year on year. That is perfectly compatible with the 2% inflation target. And when you look at real wage growth for low-paid workers, i.e. the bottom quartile, it is fading fast. That is not good politically or economically. And during the pandemic, actually in the years prior to the pandemic, low-paid workers were experiencing much better pay growth than high-paid workers. That was good for income inequality. Sadly, that is now reversed, and high-paid workers are doing much better than low-paid workers. In fact, that gap is the biggest since the early 2010s. Weekly hours worked were unchanged at 34.2, and that was worse than expected. The unemployment rate ticked up in line with expectations to 4.3%. The U6 unemployment rate, which includes discouraged workers, hit 8.1% and has been steadily rising. Participation rate ticked up, but is not great in absolute terms. JOLTS job openings was consistent with a weakening labour market at 7.2 million, down from 7.4 in July. Below expectations, the quit rate was stable at 3.21 million. The July JOLTS net hiring rate, that is hires minus separations, was weak, all consistent with a weakening labour market. But we've yet to see a surge in layoffs. So, not really seeing any recessionary dynamics yet. The ratio of job openings to unemployed people fell below 1 for the first time since April 2021. So that should all be good for keeping wage growth under control. The overall trend is a mild weakening in the US labour market. Now, we're looking at the beverage curve. Any further reduction in the job openings rate should tend to see a disproportionately large increase in the unemployment rate. Let's see what happens. The ADP employment change was weak at 54,000, down on July and below expectations. Reminder, that is hard data from the largest companies in the US. Challenger job cuts ticked up a bit, but is not concerning. Inflation in August was 0.4%, which was slightly worse than expectations, but 2.9% year on year. It's rising. We're expecting a mild rise in inflation over the coming months, followed by a mild decline. Core CPI was in line with expectations at 3.1% year on year. When you look at the contributors to inflation, well, airfares were a big contributor to the higher inflation. But the main reason that inflation was higher in August was owner-occupied rent, which was responsible for 56% of the rise in CPI. Now, when we look at the effect of tariffs, you'll see that furnishings, which are largely imported, we had a spike in inflation in May, June, and July, but it's since faded. is the inflationary impulse from tariffs fading now? Well, Pantheon Macroeconomics has estimated that only around half of total tariff costs have been passed on to consumers. Now, either that means that there's more to come, or it means manufacturers and retailers have absorbed the other half. Goods inflation continues to rise. Tariffs are having some effect. Service inflation still looks sticky, but is slowly coming down, or at least not ticking back up. Broad measures of inflation show inflation is persistent, above 3%, far in excess of the 2% target, but the Fed is still expected to cut rates later this week. Owner equivalent rent is likely to continue falling in the coming months, and that should keep a lid on headline inflation. Now, I thought this was an absolutely amazing chart. This is Japanese export prices for cars to North America, which is blue, and the rest of the world, which is green. And you see Japanese manufacturers have cut their prices by 20%. So they've absorbed pretty much 100% of the tariffs by taking a hit to their profit margins. So not all of the tariffs are being passed on to US consumers. Producer price inflation, good news, down 0.1% in August, 2.6% year on year. Core PPI also down in August, 2.8% year on year. Productivity growth, great, up 3.3% year on year in Q2. If only the UK had productivity growth like this. Unit labour costs were therefore only up 1% year on year in Q2. ISM manufacturing PMI in August was 48.7, up slightly from July, but still below 50. Services PMI strengthened 52. So labour market appears to be weakening, but services sector strengthening. Factory orders down 1.3% month on month in July, not great. Construction spending was down 0.1% in July, and that is the 9th month of negative construction spending growth. And finally, we are seeing a fall in construction employment in the non-farm payrolls report. The US Small Businesses Business Optimism Index ticked up to 100.8 in August. That's good news. Does not suggest a weakening economy. But when you look down in the details, the National Federation of Independent Businesses, i.e. US small businesses, the number reporting jobs openings hard to fill is falling. The number reporting prices rising is also falling. So that suggests the labour market is weakening, as are inflationary pressures. So this is a survey of consumers who are feeling less optimistic in September, below 50, not great. The New York Fed's survey of consumer inflation expectations ticked up to 3.2% in September. Not great, but that frankly tends to follow inflation, and inflation has ticked up. So has inflation expectations. Initial jobless claims rose sharply. That unsettled the market, but it's all due to Texas. If you exclude Texas, they look absolutely fine. So bottom line is, ignore the data point. Continuing jobless claims were stable at 1,939,000. But long-term unemployment, so the percentage of people who are unemployed who have been out of work for more than half a year, is rising and is high by historic standards. That is unusual outside of a recession. Jobs posting index falling back once more, wage growth 2.6%. So the market is not really offering a premium to change jobs. Link-up job postings, having been stable for a month, have started falling again. Now to the nowcast. This is Dallas Fed. They're saying 2.2%, which is down from 2 weeks ago. Atlanta Fed, 3.1%, still strong numbers, but down from 3.5%. Now, we know the Atlanta Fed is heavily influenced by imports and exports, and Chinese imports into the US have fallen sharply, and that could well be behind the strength of the Atlanta Fed's GDP now forecasts. The one we like most is the New York Fed, which is most stable, and it's saying 2.08%, down from 2.2% 2 weeks ago. So the US economy growing at around 2%, not showing any real signs of deterioration. However, if you look at the St. Louis Fed, they're saying the growth is much weaker at only 0.2%, and that's down from 0.5% 2 weeks ago. Citigroup Economic Surprise Index still positive but weaker. Trueflation 2.1%, really not much to worry about. And we talked about this last time, but the AI infrastructure spending is propping up the economy. So according to data from Bloomberg, the current AI boom is around 5% of US GDP, in line with other speculative investment booms of the past. When it comes to an end, a key prop for the US economy will be taken away. Now, earlier we reported US productivity numbers, which were good, and that is a key strength of the US economy. This is productivity per worker going back to 1986, and you see it's been steadily rising, and recently it's resumed its rise. So that's why the US economy is doing much better than UK and Europe, where productivity is essentially stagnant. It hasn't reached its pre-COVID levels yet. The US debt ceiling was raised by 5 trillion in July. In the last 2 months, the debt has increased by 1.2 trillion. So that means at the current rate, they'd have to increase the debt ceiling again in 6 months' time. US debt is on a totally unsustainable trajectory. So US summary. Well, non-farm payrolls came in soft at 22,000 in August, well below expectations. Unemployment rate rose. The job openings continued to fall. Inflation ticked up to 2.9% in August. Core was at 3.1%. So the US labor market is definitely slowly slowing. The US economy also appears to be slowing, but its absolute growth is still solid at around 2%. The Fed is forecast to cut rates this week. There's no new data on China this week. On to one chart. So last month, we reported that there was an MIT study that showed that the majority of companies' AI projects failed to save money or be implemented. And this data would suggest, would appear to support that. So this is the number of large companies that have reported using AI in the past 2 weeks. And you'll see it appears to have peaked. And it peaked at only 14%, and it's since down to about 10%. So AI adoption is not widespread, and on the basis of the last few months, it appears to be falling, not rising. And while we talk about AI, this week, Oracle shares rose 40% on the back of this deal with OpenAI. So, at the end of last quarter, Oracle's remaining performance obligations, that's RPOs, that's its term for contracted future revenue, were 138 billion. Now, netting off orders delivered in in the period in the last quarter, Oracle took in 322 billion of new business in 3 months. And that is an absolutely enormous number. So in 3 months, it has quadrupled its order book for future business. The market liked it. Shares surged 40%, although they've since retraced some of that. And that made Larry Ellison the richest man on the planet. But when you dig into it, a lot of that announced revenue is a long way in the future, and almost all of it is from OpenAI. So the Wall Street Journal reported that OpenAI have committed to pay Oracle $300 billion over the next 5 years. Reminder, the total increase in the order book was $338 billion. So it appears OpenAI is the vast majority of the new contracted future revenue. And this is the revenues that Oracle reports it is expecting from its cloud business. And you'll see that it ramps up exponentially over the next 5 years. That trajectory is reminiscent of NVIDIA. So Oracle expecting exponential revenue growth from their cloud business. So on the left here, we have an estimate of the future contract commitments made by OpenAI to Oracle. And you can see that they ramp up over the next 5 years. On the right, you have OpenAI's revenue forecasts. Now, as of July, OpenAI's annual revenue was only 12 billion. And let's say that it continues to grow incredibly strongly. So it grows by the best part of another 50% in the second half of this year to finish the year at an annual run rate of 17 billion. Then OpenAI are forecasting a compound annual growth rate of 65%, which gets them to 125 billion by 2029. So they're then contracted to spend 55 billion to Oracle out of 125 billion of revenues. Now, in order to hit its target and to grow 65% per annum, OpenAI will need to overcome competition from the other big hyperscalers like Google, Microsoft, Amazon, Alibaba. It will need to overcome competition from other leading AI startups like Anthropic, Perplexity, and DeepSeek. The whole industry will need to overcome electricity constraints, limit the supply of data centers, and it assumes that there's no downturn in the AI investment cycle. And even if it does hit its aggressive revenue target, the company is expected to burn through $115 billion in the next 5 years. So that's a lot of money. That is about 0.3% of US GDP. It will need to raise that money. What are its options? Well, so far it's raised about 60 billion over the course of its life from private equity. And that's assuming that the current 40 billion round closes. Raising another 125 to give it a bit of a buffer would see it absorb the equivalent of 60% of all US VC investment in 2024, which is an astronomical number and likely impossible. Or it can try and raise debt, but bond investors require profits and sustainable cash flows in order for the company to pay the interest on the debt, and it doesn't have those. So I would suggest the bond market is likely closed to OpenAI, which means a big IPO is the most likely option. Reminder, revenue growth for hyperscalers is forecast to slow in the coming years. So OpenAI's 65% per annum revenue growth going forward. That seems a tad aggressive. Bottom line, nice big numbers, all looks good in a press announcement, but the OpenAI commitments are based on big assumptions about its future revenues and fundraising ability. So is much of this deal illusory? We'll see. And onto the true money supply. In the last podcast, we were talking about Felix Sommery and his Austrian School of Economics critique of fiscal sustainability and debt sustainability. This time, we're talking again about the Austrian School of Economics and their measure of the money supply. So, reminder, traditional definitions of the money supply. M0 is notes and coins in circulation, excluding those held by the central bank and therefore not in circulation. M1 is M0 plus demand deposits plus savings deposits. M2, M1 plus time deposits of less than 100 grand plus retail money market funds. M3, M2 plus time deposits of more than 100k plus institutional money market funds, etc., etc. Now, the Austrian school doesn't think those traditional definitions of money supply are correct. In the Austrian school defines the money supply as only money that can be used as a unit of exchange in trade. So that is notes and coins in circulation and demand deposits. Savings deposits have to be turned into either demand deposits or notes and coins in circulation before it can be spent, and therefore is excluded, as are time deposits, money market funds, debt and debt instruments. And why is this interesting? Well, it's interesting because growth in the true money supply has been slower than growth in M2 over the past few years. And Austrian economists therefore say that the growth in the true money supply reflects a weaker economy, as illustrated by this chart, which shows that when there's a growing disconnect between M2 and the true money supply, recessionary pressures are rising. So, growing gap between M2 and TMS tends to end with a recession, and the gap is growing very quickly at the moment. So, the Austrian school is basically saying that recessionary pressures are rising. I am skeptical, frankly. The thing is that money supply is a measure of the stock, not the flow. So it's a measure of the stock of money. And technology has allowed consumers to access their bank accounts better for transactions, reducing their need for cash. So we're seeing a secular fall in the stock of cash, which will tend to reduce TMS in particular. But the velocity of bank account money has increased because you now just tap and go to use your bank card. Technology has also increased the ease with which money on deposit can be moved into money market funds. Apps on mobile phones now allow it to be moved almost instantly. So when interest rates were close to zero, there was little incentive to move money into savings. Now there is. Hence, the stock of money on deposit has grown relatively slowly as people have moved excess cash into money market funds. So bottom line is I found the definition of true money supply quite interesting, but I just don't think it's relevant because there's a technological change here which will tend to increase the velocity of money and reduce the need for the stock of money, in particular, cash and notes and coins in circulation. So I'm skeptical that the true money supply can be used to analyze anything, frankly. Okay, now last week I had my usual call with my fund manager friend in the US, who has been doing very well from emerging market bonds. And particularly, he's been buying the dregs. So let's have a quick look at emerging market bonds. And these are the government bonds in the world with the highest yield. So Turkey, Egypt, Ukraine, obviously because of the war, Zambia, Uganda, Kazakhstan, Nigeria, Russia, etc. And let's have a look at a few of them. So this is Turkey, and because it's got an inflation problem, it is issuing bonds in US dollars, and this is the price as a percentage of par of the 5.75% bond maturing in 2047. And you'll see that this year it's had a decent tick up. The inflation and interest rates in Turkey are coming down, which suggests that it's getting its act together macroeconomically, which should mean that it will more stability, better ability to pay. And when you look at its debt to GDP ratio, well, that bout of inflation has been great for getting the domestic debt down. So its debt to GDP ratio is only 24.7. I couldn't find figures on its external debt to GDP ratio. So that looks like a decent bet. The bonds yielding 7.5% roughly. Turning to Egypt, again, US dollar bonds yielding, so not the coupon yield is 8.5%. They're trading at a 12% discount to par. So you talk about yielding 9.5%. Inflation's coming down, interest rates coming down, but debt to GDP is a rather nasty 83%. But you see, the bonds have rallied hard over the past 18 months. That is a rise of over a third. Looks pretty good. So if you bought these last year, you'd have done very well. Turning to Ukraine, this is the price of the 4.5% 2036. I mean, frankly, the price of these bonds reflects the progress of the war, or lack of, and you'll see that really not doing great, and essentially is a punt on the outcome of the war. I personally would be avoiding. So this is Nigeria, and again had this really good rally, up 20% since its lows in April. Again, US dollar bond. Nigerian inflation rate coming down, interest rates remaining high, but strong positive interest rates now, suggesting the Bank of Nigeria is serious about getting inflation under control. Inflation's still too high at 22%. Debt to GDP, a rather nasty 53% and rising, but bonds rallying. Government of Brazil, 4.75% US dollar bond, pretty stable, but risen in the past few months. Brazilian interest rates, 15%, inflation at 5.2%. So very strong positive interest rates. Amazing. Debt to GDP ratio, 76.5%, but broadly stable. Lebanon, I mean, this is amazing. The bonds have gone from like 6p to 23p, so quadrupling in the past couple of years, and that is despite the all the tensions in the Middle East, and appears to reflect speculation that Hezbollah's grip on the country is weakening and there will be return to some sort of governance. If you think the situation in Lebanon is improving, there could be a long way to go, question mark. Venezuela, 11.95% maturing in 2031. Now, if socialist president Nicolas Maduro were to be toppled, then Venezuela has vast oil reserves which would allow it to easily repay its bonds. So the bonds have rallied by the best part of 50% since the start of the year, roughly. Amazing. Mexico, 6.05%. This is domestic debt maturing 2040. Again, nice little rally over the last few months. Inflation has been falling. Interest rates have been cut. So inflation down to 3.5%. Interest rates 7.75%. Strong positive real interest rates. Positive real interest rates should force inflation down further, allowing further cuts in interest rates, and should be good for bonds. So, bottom line, global interest rates are falling, and in emerging markets, bond yields are falling with them, leading to big rallies in emerging market bonds. And that may continue because central banks around the world are expected to keep on cutting interest rates as the big inflationary impulse from the pandemic slowly fades away. So, if you want to diversify your portfolio and gain a bit of yield uplift, you may want to consider buying an EM bond fund inside your SIP. Now, outside your SIP, UK gilts offer unbeatable value because of their CGT exemption. If you're a 45% taxpayer and you buy a low coupon bond yielding 5%, then essentially you're getting the best part of 8 or 9% equivalent pre-tax, and that's just unbeatable. Tax-free and risk-free, if you assume that the UK government is not going to default, and frankly, I very strongly make that assumption. But inside your SIP, where you're not paying tax, you can get this decent yield uplift and benefit from the continued decline in global interest rates. So some funds for you to consider. This is the iShares JP Morgan Emerging Market Bond Fund, ETF, and that is distributing, so it pays out dividends, ticker SEMB. Current yield to maturity, 6.3%. So decent uplift on the UK. The maturity of 11.2%. So an average weighted maturity of 11.2 years. This is the Vanguard equivalent, and that, I believe, is a distributing fund, so it's not paying out dividends. Yield to maturity also 6.2%, and weighted maturity in years 10.3 years. So something to consider. And on to France. So last week, the Prime Minister, Francois Bayrou, resigned after he attempted to cut the budget from 5.4% to 4.6%. Still big numbers. And French bond yields are spiking. How bad is the situation in France? Does France face a sovereign debt crisis? So this chart shows in red France's debt to GDP. And you can see that it has risen steadily from 60% of GDP in 2000 to 115% of GDP now, and it's forecast to rise to the best part of 120% of GDP in the next 2 years. So it's risen steadily. It's doubled in the last 25 years. In contrast, German debt as a percentage of GDP has been pretty stable. It's gone nowhere over the last 20 years. And France now has the third highest debt burden in the EU behind Greece and Italy. As fears over its debt sustainability have increased, so its bond yields have been rising, and the market now charges the same for France to borrow as for Italy. It has the same. Market regards the default risk as being similar, despite the fact Italy has substantially higher debts. Now, the problem for France is the primary budget deficit is big and not forecast to fall. So if you look at the bottom chart, you are looking at the black dashed line, and its cyclically adjusted primary balance is firmly negative. Other countries in the Eurozone, such as Spain, which is in grey, Italy in green, Greece in red, Italy and Greece are already running a primary budget surplus. Spain is running a deficit, but is forecast to move to surplus. France is running a deficit and not forecast to run a surplus anytime soon, and is expected to continue running big negative primary balances. And that is a problem for a country with declining demographics and a very generous pension scheme. So the green line is births and the red line is deaths. And you'll see that births have been really declining quite quickly and deaths have been rising as you have an aging population, to the point the two have now crossed. There are more deaths than births in France this year. But the big problem France has is its very generous social security payments. So this chart looks at the relative generosity of public pension funds in the EU. So the left-hand bar is generosity as of 2019. The right-hand is expected as of 2070. You'll see currently France has got the most generous public pensions of any EU country. Its generosity is due to fall by 2070. But whether the French state will be solvent in 2070 is a big question. In terms of GDP per capita, French pensions are about 15% more generous than the EU average, although their generosity is forecast to start coming down in future years, which is good because the dependency ratio, the ratio of dependents to workers, will continue to rise in the coming years. So in the last 25 years, you've had a substantial increase in the number of dependents per worker, which means that social security payments to non-workers are becoming increasingly burdensome, and that is forecast to keep on increasing over the next 50 years. Now, France currently spends around 14% of GDP on pensions. That's around 24% of government expenditure a quarter. And France's spending on pensioners is very generous compared to its peers, although the UK is rapidly catching up. And the income of French pensioners has grown much faster than those of the average French worker over the last 50 years, to the extent that French pensioners now have higher incomes than the average worker, which is extraordinary and surely, frankly, immoral. How can a non-worker earn more than the workers who are supporting him or her? So in 2021, France spent around 34% of GDP on social protection, compared to the EU average of 29.5%, i.e. 4.5% of GDP more, or about 15% higher. So 56% of French state spending is now on social security, creating a dependency problem. And if we look at the unfunded pension liabilities for France, they equate to 400% of GDP, which sadly does not make France that much of an outlier. All the EU countries have big state pension provisions into the future and therefore unfunded liabilities. If you look at private sector pensions in France, pension assets as a percentage of GDP were only 12.2%. That compares to 124% in the UK and 170% in the US. France and other EU countries have big state pension sectors and small private sector pension sectors, and that means huge unfunded future liabilities for the state. And the French state just continues to grow. Government expenditure as a percentage of GDP is now 58.4%, the highest in the EU and one of the highest in the world. Its tax rate is 43.8%. the highest tax rate amongst this basket of OECD countries, higher even than Denmark. And that is driven by very high social security contributions. In 2024, total tax receipts were 51.4% of GDP, expenses was 57.3%. Big gap between these two. Now, if we retrace the clock by 50 years to 1980, France's public debt to GDP ratio was only 20%. It's now around 114%. So over that period, public spending as a percentage of GDP has risen relentlessly. The state keeps spending more and more and is dominating the French economy. And this chart shows that although in the good times, France has managed to cut the deficit every time there's a sort of crisis, it opens the fiscal taps, stimulates the economy, and the fiscal balance deteriorates sharply. And we are here because it opened the fiscal taps during the pandemic and has not got them back under control. Now, when President Macron came in, he cut taxes and hoped that those taxes would pay for themselves through higher growth. Sound familiar? Reagan-esque supply-side economics. They didn't. And now those tax cuts are part of the problem. In addition to government spending increasing as a percentage of the economy, so the number of people who work for the state has increased. Between 1996 and 2020, there's been a 23% increase in public sector employees, mainly in local and regional government, although also the health service has expanded hugely. So France has a fiscal problem. Its deficit is big. It's grown since the pandemic and is not under control. And President Macron's party is small, meaning he has to rule in coalition, and he is unable to get a consensus to cut the deficit. All of his prime ministers who have tried have ended up failing and being forced to resign. So currently, the right-wing Front National, the National Rally, is in the lead in the polls, and both it and the left-wing parties would instigate populist economic policies if they were to be elected, and that would further expand the deficit. So this chart shows in yellow Macron and his allies what they are hoping to achieve. So they're hoping to get the deficit at least stabilized. Bayrou was aiming for a deficit of 4.6% this year. He's fallen on his sword. The National Rally and the Socialist New Popular Front would increase the deficit towards 7%. And that would be very unpopular with the bond market. So let's look at the manifestos of the left-wing New Popular Front. So they would aim to reverse the rise in the pension age from 62 to 64, which is one of Macron's key achievements. They'd immediately raise public sector wages by 10% and housing subsidies by 10%. They'd raise 15 billion from a tax on corporate super profits, whatever they are. They'd also raise 15 billion from a wealth tax, or at least they would aim to. I suspect they would get nowhere near that much. And they would instigate 14 new tax brackets with the highest marginal rate of 90%. The Laffer curve would tend to suggest they will get almost nothing from that. They would aim to raise total government expenditure by 100 billion, initially rising to 150 billion by 26-27, but they claim that all that extra spending would be funded by further tax increases, i.e. increasing the size of the state yet further, and there would be no increase in the deficit. That is left-wing fantasy economics. Now, on the right, they are not going to reverse the increase in the retirement age, but they're saying workers who started work before the age of 20 would be able to retire at 60 instead of 64. They'd also index pensions to inflation, which is bad. We've seen previously that the relative generosity of pensions is due to come down in the coming years. If you index them to inflation, that wouldn't happen, exacerbating future fiscal deficits. They would cut taxes on electricity, gas, and energy from 20% to 5%. They claim they would save billions by reducing immigration and cutting welfare payments to foreign nationals. Everyone says that. And they would save 2 billion euros a year by cutting France's EU contributions and 65 billion by cracking down on tax evasion and welfare fraud. The Institute Montaigne calculates that its economic proposals would cost around 38 billion a year. So they would exacerbate the deficit. And these are the latest opinion polls. The right wing, Rally National, has 33%, the Socialist 25%, Macron's party only has 15%. Now, the next election is in 2029. If Macron can no longer govern, then, and there was to be an election, it's likely the right-wing Rally National would have the chance to form a government in coalition. And another problem for France is that because of all the red tape, and rather like the UK, its productivity has stalled, and economic growth is a function of productivity, particularly when you have a declining population. As we talked about earlier, Fitch has cut its credit rating for France to A+ from AA-. And the bottom line is there is no political consensus in France to dealing with the deficit at a time when the bond market is very concerned about fiscal sustainability. France has been running a deficit continually for 40 years, and its debt to GDP ratio over that time has gone from 20 in 1980 to 114 now. And so at some stage, that trajectory has to come to an end. Bond markets are jittery, French bond yields are rising. Unless there's strong and immediate action to tackle the deficit, then you can get into a sovereign debt crisis and a negative spiral whereby higher bond yields raise interest costs, which increase the deficit, which increase borrowing costs, and you get into a negative feedback loop. Of course, the ECB could act to avert that by A, keeping interest rates low, and B, stepping in to buy French bonds. But that would simply serve to allow France to keep running a deficit for longer until the deficit really became a problem. In the absence of internal pressure to fix the budget deficit, external pressure will need to be applied. And that means either the bond market or the IMF, or likely a mixture of the two. So what happens next? Well, unless something is done to fix France's fiscal balance, it's likely that French bond yields will continue to climb. France has debts of 3.3 trillion euros compared to Greece's 320 billion when it was bailed out. So France is far too big to save. So what are the fixes? Well, there are three fixes. Either France gets its act together and imposes austerity to reduce the budget deficit and imposes pro-growth policies, so by reducing red tape, etc., or a crisis follows, unless the ECB artificially suppresses yields and kicks the can out down the road. But if it does that, a crisis will occur at some stage. So who benefits? Nobody, really. Safe haven assets. Gold? I can't think, frankly, at the moment, it's difficult to see many other safe haven assets. Normally, it's government bonds, but right now, markets are concerned about fiscal sustainability. There are very few countries with a sustainable fiscal situation. Switzerland, even Germany has now opened the fiscal taps and is no longer considered a safe haven. Watch this space. Okay, quickly on to technology. So this is Lyft, which is a competitor to Uber, and it is finally profitable, but it's not really profitable when it has spent an awful lot of money getting to, what's that? Break even, bare profitability, high hopes, actual revenue, disappointing. And ChatGPT traffic has now overtaken Wiki traffic. Given that Wikipedia is verified, ChatGPT has a history of hallucinations. Is that a good thing? We ask ourselves. Now, in Dubai, this air taxi startup has completed a series of successful test flights. Are air taxis now are going to become a reality? Been talked about since at least the 1970s. Let's see. And forget humanoid robots. Specialized industrial logistical robots are commonplace. So Amazon has 1 million of them as of this year. Astonishing. And that has resulted in a 22-fold rise in labor productivity in Amazon warehouses over the last 10 years. And finally, Recession Watch. So this is the latest delinquency rates in the US, and frankly, they're high, but they do seem to have peaked for auto loans and credit cards, although at least they're no longer rising. Student loans, however, are going through the roof. Not great, and that is higher than the highest it's been in the last 20 years. So this chart shows just auto delinquency rates and confirms the highest they've been since the GFC. We look back at this chart, the only time they're higher was GFC and around. And I remain absolutely mystified by the US housing market. So the chart on the left shows in purple new homes completed and sold. The blue line is homes sold which have been not started plus under construction. Now, normally you see houses sold prior to an off plan or under construction. Now, for the first time in a very long time, you're seeing houses sold once they've been completed. And that suggests that construction companies are struggling to sell them off plan. But we've seen that the construction market in the US continues to be strong. Lots of new houses continuing to be built. Will that finally change? Construction spending, as we reported earlier, is falling, which has a very good correlation with the start of previous recessions. Take a look. As talked about many times, the way recession normally starts is falling jobs in the construction and manufacturing sectors, leading to a cascading declines in spending throughout the economy. And new home inventories just continue to rise, particularly in the South, where there was a lot of speculative building for second homes. Many years ago, at the start of this podcast, we were talking about how temporary help services employment is a leading indicator. Well, it's been falling for a very long time now, and we haven't had a recession. In fact, the fall in temporary help services employment is the worst since the tech bust of the early 2000s. And JP Morgan are forecasting the US will suffer a technical recession in the second half of this year. Well, we're midway through Q3, and that forecast isn't looking too clever currently. The market is pricing in only a 21% of a recession in the coming year. Although US unemployment has ticked up recently, it remains below where it was last year, and therefore SARM rule, which, reminder, looks at the increase in unemployment over the past year, is actually declining and is not showing any signs of a coming recession. So Bottom line, current economic cycle is looking like it's weakening, but there's little sign of an actual recession yet. And finally, on to good news. So this is rice. In 1975, the average yield per hectare was 2.4 tons. Now, the average yield has almost doubled to 4.7 tons. So in 2008, rice prices hit an all-time high of $1,000 a ton. This year, $375 a ton. So we talk a lot about technological improvement, and this is a great example of traditional technological improvement. So by improving irrigation, fertilizers, and seeds, farmers have managed to double their productivity in rice production over the past, 50 years, which is great news for food prices. So concluding comments, well, more of the same really. Last couple of weeks, equities continued to rise despite weakening economy, I'd say. Precious metals doing very well. Bond yields appear to have peaked, but bonds have had a terrible year, as the US labour market appears to be slowing and the Fed is expected to resume rate cuts this week. Now, I just quickly want to talk about some of my disastrous investments. This is in, so I have bought income in the form of REITs, and some of them are, a big chunk of them are in renewable energy. So this is the Renewable Infrastructure Group. It currently yields 10%, discount to NAV of 31. And I bought it probably around here when it was yielding best part of 8%. Now yields 10%. What's happened is the NAV has continued to fall on the back of continually revised lower future energy price assumptions, which is depressing, in fact. And in order for a sustained rise in the share price, you'd need to see a turnaround in that trend, stabilization of future energy price assumptions, and also interest rates coming down. So the idea behind the trade in the first place was that as interest rates came down, so the assumed discount rate used in calculating the NAV would fall, which would raise the NAV, and also the discount to NAV would fall. You'll notice that as interest rates have risen, so you had a falling NAV and a widening gap between NAV and share price. Both of those should reverse as interest rates fall. So here's hoping. But in the case of renewable energy stocks, been caught out by falling assumptions about future energy prices, electricity prices. Greencoat Wind shows the same. Now it has a dividend cover of 1.3 times, and its dividend yield is 9.8%, discount to NAV 26%. So I think it's got a lot of margin for error, and I'll not be selling, and I'll be taking my 10% dividends, but not looking very clever. Okay, that's it. Thank you all for watching. The next one will be in 3 weeks' time. It's a great pity that Richard was unable to join us this week. It's more fun for everyone, but hopefully he'll be back next time. In the meantime, be safe out there, and thank you for watching. Please press like and subscribe to the channel. And it's goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.